Hi, it's Chris Titley here, and today we're joined by Tom Millner, Portfolio Manager from Contact Asset Manager. Tom, it's been a while, but good to see you again, mate.
You too, Chris. Thanks for having me.
Let's talk about the history of Contact and the product that you manage, BKI. If you want to give the listeners out there a little bit of an understanding on what it is.
Yeah, sure. In December, BKI hit 20 years, having been listed in 2003. We listed with a $172 million market cap back then. We're now managing a bit over 1.4 billion. And since that time, we've paid out over $1 billion in dividends and franking credits. So I've been involved with BKI since the prospectus. We listed it. And then during that time, I've been CEO of BKI. I've worked externally for BKI. But then in 2016, we created Contact Asset Management, myself and business partner Will Colbert. And we've been managing BKI since 2016. And then with that, we've also got an X50 fund that we run as well, which is coming up to its fourth year. So it's been a long association with BKI, and I suppose it was just a really nice milestone in December to hit 20 years.
Yeah, no, absolutely. And now I seem to recall a little history of the name of Contact had something to do with a horse back in the day. Do you want to give that story?
Yeah, it did. Will's great-grandfather and my great-grandfather were good friends, which is nice because Will and I are obviously good mates. Will's great-grandfather was a horse trainer, and my great-grandfather was an accountant who liked the races, and they had a few horses together, and their most successful horse was called Contact, and it ran fourth in the Melbourne Cup in 1935, and then in 1936 won the Sydney Cup. So it sort of typifies our investment philosophy. It was a long distance runner, a bit of a stayer, wasn't a sprinter, and so that long distance, long term, I suppose mindset was another reason we thought we'd better call it Contact.
Yeah, no, absolutely. Mate, congratulations on the milestone and certainly the performance of the fund. Do you want to talk about some of the attributes and what you look for when investing within the fund and the goals around investment per se?
Yeah, well, I think with BKI, it's been quite fortunate to be listed and will have a closed-end structure. And it's a bit like the whole Soul's Pats theory of co-investing with like-minded people and having that long-term, I suppose, mindset. But having a closed-end structure means that in a downturn, and we've had a few over the last 20 years, you're not a forced seller because people are redeeming units in your fund. You can actually use your cash and buy stocks at a really good valuation and hold them for the long term. So we've been able to do that a few times over the last 20 years with BKI. And, the most recent period, COVID, we got a really quick, short window in being able to buy some stocks at ridiculously cheap prices and hold on to them for the long term. So with that, it's been a bit of an advantage, but also it's enabled us to go into the small and mid-cap space as well and grow with a founder or a family who have brought a stock to market. And there's been a few names that we've done really well out of. Some of them are household names in the stable with New Hope and TPG, but others, Ramsay Healthcare, Sonic Healthcare, Goodman Group, Lindsay Australia, ARB, Reece, those sort of companies we've held for, best part of 20 years and growing with them because of the closed-end LIC structure.
It's an interesting point you make around the 20-year sort of horizon that you've held stocks for because market cycles generally go up and down, sort of exaggerate on the downside and on the upside, but you're tempted along the way to trim or sell some of these holdings. I'm always fascinated to hear about long term, but then all of a sudden if something goes up 40%, you think, oh, maybe we should take a little bit off.
Yeah, you do. It's very tempting, and there's a stock that comes to mind at the moment it's a family-run business. They're very well aligned. It's a great product. It's been listed for a long time, and we've held it for a long time, and that's Reece. But it's trading on 40 times. So, part of you thinks, okay, look, is it time to take some off the table? Do you sell and deploy that money elsewhere in the portfolio with better value? But we just keep coming back to the fact that quality always wins. And, the Wilson family have been there for a long time. They've been very successful, created an amazing business. And, from a BKI point of view, I think we'd be crazy to sell at these levels.
When you have a stock that you've held for a long time and there's maybe a change of management, I mean, how often do you catch up with these companies in regards to company meetings, and or if there is a change of management or change of potential strategy, how do you get your head around going, oh, maybe this might work or might not work?
Yeah, that's a good question. We're sort of at the size and scale of BKI now where we do get good access. We have meetings probably twice a year at least with companies from CBA to BHP, right down to some of a smaller company worth $200 million market cap. So we do get good access. We meet with management at least twice a year. Change of management's always a good opportunity to dust the dust off the folder and have a really good look at the business, at the strategy, what the history or track record of the new management is coming into the business, what their incentives are, what their timeline is looking like, and it's probably a good reflection point on just assessing the investment opportunity.
When it comes to macro trends, I remember in 2017 when I went to Buffett and at the AGM and caught up with you, they were talking about AI and they were talking about the fast-paced nature of technological change. How much do you keep abreast of that with your companies, and sort of do you buy into some of the hype about particularly AI and the way it's changing and the super fast-paced nature of it?
Yeah, probably not from an investing point of view, but we do obviously want the companies that we invest in to spend a little bit of time and money on digitalization and technology and now AI and being progressive, because at the end of the day, it's done properly, it's there to help, right? So, a company that comes to mind here is Sonic. You've got your pathologists, they're studying a sample. Typically, they'd be over the microscope taking notes. Then they take those notes, they type them up, they then send them off to be processed, and then it gets back to the GP. Now with AI, they've got voice recognition. They can talk while they're looking at a sample through a microscope. It fills out a form automatically that is then digitally transferred to a GP, and results of those tests are pretty much instantaneous. So there's good and bad AI, and we're sort of learning and seeing that emerge. But Sonic have been doing this now for a few years, and the savings from a cost point of view is, sorry, the lights have just gone off there.
Well, that's all right. No one can see that.
There we go. I was in the dark. I'm sorry, mate.
Got to pay the power bill, mate.
That's exactly right. So Sonic have used this, and they can now do many more samples a day, generate better profits on a per day basis, which annualized can be quite a nice little nest egg for them. But you do have to embrace the technology, invest in it, and then use it properly.
When you look at some of these companies and their growth companies, you talked about Reece, you talked about Sonic, etc. How important is the dividend? And also when you're looking at some of the growth companies, maybe the $200 million market that mightn't be paying a dividend, the prospects of a future dividend.
Yeah, well, we've got two products. BKI is very reliant on dividends. That is our revenue and our profits that we then pass on to our shareholders. So dividends, growing dividends and a yield are really important for our shareholders. The fund, our Contact X50 fund, is less focused on dividends, but companies still do need to pay a dividend. It doesn't have to be a high yield, but we believe that if a company has the ability to pay a dividend, there's a lot of other things that have gone right before that. So not only is revenue there, profits are there, they're paying taxes, they're spending money on R&D and expenditure, but there's still surplus cash flow to pay out to shareholders. So dividends are really, really important in the makeup of our, I suppose, investment.
And how important do you think it is now in the macro environment per se, in terms of the cost of living and rates, etc., where dividends sit and the benefits of franking credits?
Oh, absolutely, they're vital. Most shareholders in BKI are probably in pension mode, or have got a self-managed super fund, or a young guys starting out, and they might be in accumulation phase, and the dividends that they receive can go into the DRP so they can accumulate more shares. But that franking credit attached to that, they might be on a tax rate of 30 to 40%, and that franking credit can offset some tax that they pay there too. So it's very important right across all shareholders.
And when it comes to weighting the portfolio and seeing different positions go up and down on a daily basis, if one gets to a particular level, what do you do? Do you have a meeting about the stock, or do you have to potentially sell some?
No, not really. We've got Our active weights at the moment, we've got 5% active in Macquarie and APA. That's probably pretty skewed to the top end, or the pointy end, if you like. That'll be it's pretty active management, but we take the view that Macquarie is a great company and APA is a great company. NAB, we're overweight about 4%. So, a lot of, I suppose, traditional fund managers would own all banks. We only own CBA and NAB because we just think they're the better quality businesses. We're happy to grow with a business. So, BHP's, I think, our number one stock at the moment. We're happy to keep investing in that if they keep growing.
And the market in the last little year or so, I left Morgan's in May of 2022, and the index was 7,300 ex-dividends. I think the market's around 73, 7,400 coming up to 2 years later. Again, not including dividends. What's your thoughts in the last little while, and then moving forward?
Yeah, I think that's a really interesting point you've made there, Chris. We always look at the accumulation index because we do have a real focus on dividends and the ability of Australian companies to pass on dividends and franking credits, which we've already spoken about. But those numbers, they have grown quite significantly over the last 12 months, but also over decades and decades before that. So I think in the 12 months ago, if you said the market was going to go up 13%, including franking credits, which it sort of did over the last 12 months, people would have thought you're mad. But as fund managers and long-term investors, you got to stay positive. So we've been pretty much fully invested over that time and done reasonably well.
Speaking of staying positive, you have a new stock, or a new stock enters the portfolio after significant due diligence, and then all of a sudden it dips 15 or 20%. Do you double down, or do you keep an eye on it? What's your process when things don't always go to plan?
Yeah, and sometimes they don't. One that we probably got wrong recently was James Hardie. We waited and bought it really, really well. Change of management. The new management team came in basically and said, listen, we're going to try and restructure this business. There's a few things that we need to sort out, cost cutting. One of the things that we're going to start with is cutting the dividend. And because dividends are so important to BKI shareholders, we'd done well out of the stock. We'd made money, but we thought, okay, we're not going to get a dividend out of this company for a couple of years. So we actually sold it. As it turns out, we've probably left 25, 30% on the table on that trade. It wasn't a huge position in the portfolio, but it just sort of goes to show sometimes when you get really focused on something, you might miss the other elements of the story.
And then when you come together as a group to look at the lessons from that, do you sort of analyse your losses, I suppose, and the ones that didn't go so well, and use those learnings into the future?
Yeah, absolutely. James Hardie's exposed to the US housing market. We've got really good exposure there through Brickworks and Reece. So, the underlying currents of that sector was actually quite positive for both Reece and Brickworks. And we talked about Reece before, but its performance over the last little period has been really, really good. So what we sort of lost with James Hardie, we've more than made up for it with our holding in Reece, I think.
You did mention that you've held stocks for 20 years. Have you got a sort of a metric on how long you've held the portfolio on average?
Yeah, we only turn the portfolio over about 9% a year.
Right. So the whole portfolio in basically 11 or 12 years. Yeah.
Yep.
Yeah, fantastic. Excellent. Tom, the plans for BKI, just to keep status and keep going as is in terms of providing a good dividend yield for shareholders?
Yeah, keep going. Keep trying to, I suppose, increase our exposure and a bit of marketing, and make sure that discount to NTA is under control. And it has been over the last 10 of the last 20 years as we've got bigger and we've got a bigger market cap, and the size and scale of the business has grown. That discount's narrowed to somewhat of a premium every now and then, which has been great. So that's something we're really going to concentrate on. But also, just always growing the dividend for our shareholders is imperative to us. And all that comes down to is continue to pick good quality long-term companies.
Tom, one final question. You've seen a lot of cycles in regards to investing, the ups and the downs and the macros and different changes of prime ministers and interest rates, etc. Where are we now? Are you okay with where things are at?
Yeah, we've been positive for probably the last 2 years, where people think we're going to hit a recession and things are going to slow down. We've got an amazing country here that we've got the benefit of investing in. We've got an amazing resource and energy sector. We've got an amazing agricultural, tourism sector, education. We've got huge tailwinds there. But the other sleeper that people sort of forget about is the 12% contributions of superannuation. Typically 25% of that goes into our Australian market. So we've got this unbelievable tailwind of growth going into our market, and that's sort of our backyard. So it's not a bad tailwind. So with those sort of thematics, we're quite positive on the future.
Tom, on that note, I'll leave it there. Congratulations on what you've achieved with BKI and also with Contact and the funds that you manage, and really look forward to catching up.
Great. Thanks for having me, Chris.